Let me just break in. We're getting some headline flashes on this right now. It looks like the fourth quarter number for JP Morgan, $2.57 a share. Street had been looking for $2.35. Revenue is better than anticipated. It's $28.3 billion versus the $27.9 billion the Street was watching for, too. Again, these are just headline flashes, so I can't tell you everything that kind of goes into some of these numbers. They do say that the end book value was up 8% to $75.98, $75.98. Non-interest expense, $16.3 billion. Return on common equity, 14%. Provision for credit losses, $1.43 billion. Mike, what jumps out at you?
It sounds all very consistent. Obviously, it's a pretty good margin to beat on the bottom line. You want to see what went into that. The trading line is the one thing we don't know much about in terms of being able to predict it, but it seems like a good number. The big question, to Marty's point, is just whether the premium being built into JP Morgan after this great run is still going to be able to absorb, whatever is in these numbers, because it really is pretty high.
What's your knee-jerk reaction to that question that Mike just posed? Is there a reason to still have a premium in the stock?
Well, the reasons is the fact that they're just looked at as a high-quality, safe place. So when folks rotate back into banks, it's the first place they kind of go to. That has to then kind of shake out and send some of the investors down to the more discounted stocks like Citigroup at this point is a little bit better value.
Well, and Citigroup has been a huge performer over the last year.
Yes.
I guess that's the result.
It's a catch-up, right?
Yeah.
It was falling behind in 2018. 2019 it started to catch up, but still has some farther room to run here in 2020.
What's fascinating is JP Morgan, just in general analyst sentiment, you only have about a third of the analysts recommending it right now because the price and the valuation have gotten up to a point relative to the other banks, so it's just hard to kind of find a reason for it. This is what's going on in every sector, by the way. The market is just going for the big winners, the consensus best quality names, and just building up a premium.
But it's almost like Yogi Berra. That place is too crowded. Nobody goes there.
It kind of seems like that, right? And yet it looks like it's going to pop on pretty good numbers today. I think you could bank on them talking about the consumers very strong. If you believe what the
as you said that, but let me just read the blurb that comes. U.S. consumer continues to be in strong position. Yeah. That's the flash that hit, as you were saying.
Which isn't surprising, but it's still comforting. And I do think that if the corporate credit market, if you look at the way junk bonds and investment-grade bonds are trading, if that's telling you something important about how long this expansion can go and how long it's going to be till we have to worry about defaults, then banks are okay.
Is the corporate debt market telling us that, or is the corporate debt market just kind of aligning itself with Treasury prices?
The spreads to Treasuries are pretty tight. So even relative to Treasuries, it looks like they're. But now the question really, Becky, is it just that there's this global scarcity of reliable yield, and that is causing this kind of high prices and low yields in corporate debt? That's a bigger question.
Marty, you want to weigh in there?
Yes, we have a credit cycle monitor that actually looks at when we're going to see that cycle turn. Andrew, we've talked in the past, and you said, well, you have so many banks on strong buys.
Yep.
It was the fact that that discount was coming in, and our model was telling us it wasn't going to happen. So we still think that we have a horizon through 2020 and 2021 before we really see that event start to percolate. So we feel confident. That's why the banks, as we got that discount last year, really were one of our, really favorable on our outlook. We've now caught up, and so we now have to kind of look beyond the high-quality names and look at some of the ones that are less likely to be the first entry point.
What's your top entry point name?
Yeah, like Regions Financial. They have an anomaly on their net interest margin, like we talked about. That's the key thing this quarter. When you roll in the first quarter, they have some interest rate swaps that come on board, which actually will increase their net interest margin when everybody else's is still going down. So it's kind of an anomaly, but their discount with that fundamental fact is one of our favorites.